Hey, hi. Yeah, today I just want to share a bit about the 8 important things that you really need to know when you want to select a stock during this very volatile market. Um, the first thing you need to really look at before deciding to buy a stock, the number one point is to look at the VIX index. This is the volatility index. Um, I'm showing you a 1 year chart, which is currently now it is at its peak, or even a 5 year chart. And of course 66 was the highest that it went because that was during the uh, COVID crisis. So as you can see, most of the stocks, especially in US stocks, yeah, they will tend to rebound uh, back to because the growth is pretty consistent for the past 20, 30 years. So, you want to ensure that you are buying the dip, not buying the dip of the dipper or dip of the dipper of the dipper. So, looking at the VIX index is a good indication because for a stable market, it's always around 15 to 10 to 20. So, at 32 means that very highly volatile, means there are good opportunities. The second point is always to go in. Let's say you like a particular stock, go in 10 tranches. So you do a dollar cost averaging method, and very disciplined buying. Let's say if you want to put 50,000, you just put 5,000 once a month. Again, remember, you can never time the market. Timing the market is actually very difficult. Time in the market is correct. So you just decide when you want to buy in once a month. Um, the third point I wanted to share with you is when you want to buy a stock, right? Always look for the moat, economic moat. Moat is a term popularized by Warren Buffett. Basically, it says that economic moat means a competitive advantage, essentially any factor that allows a company to provide a good or services that similar to those offered by its competitor, outperform those competitors. It means a market leader, and a competitive advantage with low cost advantage, something like Tesla, and cheap access to raw material. Maybe like for now, their manufacturing plant is in Mexico or in Brazil, and very little exposure to China or Europe. Um, so this is something that you want to go for, like Google, for example. This could be a tech company, quite a monopoly, market leader as well. Apple, of course, but of course, the harder it is to find those rough jewel, that haven't actually gone up yet in the Russell, the small and medium cap stocks that can be the next Tesla or the next Apple. That's the hardest part. So the fourth point to look for is to always look for the world economic news. But just take note that all these world economic news are short term. So every news that you see, whether it's a short term bad news or bad catalyst or a positive catalyst, right? Always think in your mind whether they are short term noise or long term noise. So give yourself based on your gut feeling, you can decide on that. Um, so back to the point number three, which is you look at the companies as economic mode, then you buy it, have conviction, you must believe in the story, their present growth and their future growth, that they will have all these terms fulfilled, and stay confident. Don't get jittered because the market, the price movement of all that. Number five I like to share with you is try to go for companies that has either low PE, or if you are really you like Russell stocks, those 10x stocks, or 10x potential stocks, right? Go for the low price to sales ratio. I just want to show you an illustration of some low price to sales ratio companies, right? So, for example, let's say price to sales ratio, because they are just basing on their revenue. So, meaning higher revenue, which is good. So, but they could still be suffering losses. most Russell stocks or new technology startup, it's like if you're behaving like a venture capitalist, there's nothing wrong with that, to become like a seed funder, but just that these companies are listed. Just make sure that a ratio of less than one indicates that investors are paying less than RM1 or $1 per one company sale. Any number than four is commonly considered unfavorable. So, okay, I just give you a couple of companies that I like, which is, like for example, F Point, their price to sales ratio is 1.4. That's decent. Now it's now it's working at trading at about $5.30. Then if you look at Facebook, the current price to sales ratio is around 4.97, which is above 4 slightly. But again, it's probably a bit wrong to look into Facebook, because Facebook is actually like a hybrid. It currently has earnings already, but because of its potential, its year-to-year growth is not like those very conventional, like Coca-Cola or Pepsi, that they grow like 2-3% per year. But it's still considered, Facebook is still, or Meta is still considered like a company that has a lot of very strong future growth. You're talking about 20% per quarter, or 10% per quarter, or 30% per quarter. So people still look at their price ratio to determine the fundamental intrinsic value of the company. Then, of course, number six is, always you can also look at the trending short-term stocks, trending stocks right now, especially with all this war. Look at, like for example, Ukraine and Russia. Like for example, I give you Russia being the world exporter of fertilizer, and there will be a shortage. For example, this could be some news that you can take advantage of. Like for example, Russia is the world number one wheat exporter, which is also, you will see flour and all that increases. Grain exporter, largest as well, with all the sanctions going on Russia. You never know, the price of consumer staple may go up as well. So if you look at the Global X, this one ETF, there are a couple of good companies as well, Fortune 500 companies that produces fertilizer in US. And I think it's good time to enter them, because they are pretty much, what do you call it, will be high in demand, because Europe will be buying from them, and other companies will be buying from them as well, instead of Russia. So this is something that you want to look out for trending stocks right now. This is a wheat ETF. You can see the chart; it's gone up a lot. I believe there's still a growth cycle for all this. Just remember, when you go for all these kind of commodity, or wheat or grain stocks, right? They work in cycle. Their charts are very different from Google or Apple and all that, where you can actually see a S curve all the way up, like Tesla, like infinite growth kind of thing one. But for uh, commodity price charts, it's always like a up and down pendulum. So take note of that. So so number seven is, just wanted to show you, always look for stocks with good pricing power, meaning that they can, in the midst of high interest rates, let's say they got bank loans or spiral salary wages, they have a labor intensive kind of business like factory and all that. So just make sure, or have a gut feel, do a bit of study, that they are able to transfer the cost to the consumer, and then consumer will still buy. It doesn't mean that the consumer buying power will be less. You may look at Tyson poultry farming, like for chicken and beef, or pork, where people will need to buy them, even though they increase by 20 cents. Uh, or Coca-Cola, let's say, is already $1, for example. The retail price they want to increase to 105, but that's like 5% profit margin, additional for them, so they don't have to absorb the cost. What I'm trying to say is this. So just a quick one. I'll touch on Chewy, my favorite stock. If you're pet friendly and you like pet, you want to have a passion buy, right? Then this is something that maybe you might want to. It's still below 4, so not too bad. 3 point something. Yeah, latest um, uh, price to sales ratio. So And then number nine, number eight, right? The last one is very similar. Number seven, as you know that the interest rates hikes will be happening, so companies that are highly geared, um, which I think at Russell are quite in exception because they do a lot of capital raising, so they are not affected by the interest rates. Commercial banks interest rates increase. You may look at Royal Caribbean or MGM, especially asset-based companies, right? They would have a huge amount of loan in their portfolio, in their P&L or balance sheet, and then 1% increase will affect their profit margin. And also companies that are labor intensive, there are those especially that have not adopted in AI or technology, so in this situation, if you look at item number eight on these stocks that are not affected by high interest rates or high wages, right? Then tech may seem to be the gameplay, software companies like Fpoint or Salesforce or cybersecurity companies. If you see that their price to sales ratio are below four, and then you feel that they work on just a couple of hundreds or 200 or Facebook, of engineers or software engineers, and they don't have that many, and they can scale the business worldwide. A mode also is one of the criteria for mode is to see whether the business can scale worldwide, not just scale domestically in US. So yeah, so take note of these 8 points. Yeah, thank you very much.